Next, we're going to look at how the accounting principles work and how the regulations work, both in self-regulation and governmental regulation. First is an organization called the SEC. SEC stands for Securities and Exchange Commission, and they oversee publicly traded companies. That's the main thing they do. Second is we have the FASB, the Financial Accounting Standards Board, and this is a self-regulation group of CPAs. They're accounting professionals who come together to set the rules for their profession. It is not a government entity. It is a professional organization. Third, we have the Public Company Accounting Oversight Board, PCAOB. The PCAOB was formed from this horrible time when we had a lot of fraud and abuse. You may have heard of Enron during that era in the early 2000s. There was a lot of abuse, so Congress voted for new laws known as Sarbanes-Oxley, and as part of the law, they created yet another organization called the PCAOB to oversee public companies. And so these are the three primary sources of regulation and rules for the accounting profession: SEC, FASB, and PCAOB. And graphically, the accounting standards are set by SEC for public companies, but by FASB, and then they dictate the rules by which the four statements are created. And then the FASB creates GAAP, which are the accounting rules, and then GAS, generally accepted auditing standards, are kind of overseen by PCAOB, because these look at the procedures by which CPAs do their work in assuring that the statements are legit. And so this is kind of the relationship between the three entities. The information that we see in the financial statement is valuable, but there's more components. So the first is, in a financial statement, you'll see an MD&A. I mentioned that phrase before. An MD&A represents the management's discussion, right? So it's management looking at their own results and interpreting and explaining what happened. Now, the reason everyone kind of watches these with a careful eye is that they could be spinning their own story, and they sometimes do. So they could be only highlighting good news and not fully disclosing the bad news, right? So MD&A should be read because there's mostly, by and large, good stuff in there to read and understand. But you have to be a little bit skeptical that know where it came from. It came from management. So you might have to supplement that with your own analysis to see if you agree with their conclusions. The second is an independent audit report. So this is what the CPA firm who comes in and audits the books of a company, they write a 2-page report on how the company has done in their financial reporting. And it looks at the quantitative side of their statements, but it also does an evaluation of the internal controls, which is, again, what went wrong in Enron. And so it looks at two things. It looks at the statements as they lie, and also the accounting procedures and internal controls that exist in the company. That's what the audit report covers. Next are what we historically have called footnotes. That's not really a good term these days. We like to call it notes, because footnotes sounds like an afterthought. These are notes to the financial statements, which aren't numbers. There are numbers there, but these are paragraphs of very technical jargon that describe what's happening in the business. And this is the painful part of accounting, I must admit. So for a publicly traded company, they have 4 statements. That could be 4 pieces of paper. And yet the financial statement is, say, 100 pages. Like, what's the other 96 pages? Well, they have 2 pages of the audit report. Okay, great. What's the other 94 pages? Oh, they have 20 pages of MD&A. Okay, great. What's the other? I lost track. What's the other 70 pages? Well, the other 70 pages are notes. 70 pages of notes describing the financial statements. So you can't ignore them, because there are some things that you could see in the notes that are not seen elsewhere. So it's an essential part. Again, not many people have the patience or the knowledge to go through all of the notes, but we will be going through to cherry pick which notes are essential for what things, right? And we'll do that. And the last thing there are other regulatory filings and proxy statements. I mentioned the word proxy previously, but these are filings done with the SEC, and it could be something like when Steve Jobs was alive at Apple. Steve Jobs was having an organ transplant, and that was disclosed. Why? Because it was important to the customers, suppliers, investors, and bondholders that Steve Jobs was going through an organ transplant, right? So it could be just news that is relevant to investors and other readers and users of financial statements. Or it could be something more mundane, like the company is announcing that it is buying back stock, right? That's a required thing to disclose. It's not quite as exciting or newsworthy as Steve Jobs having, a new organ being transplanted, but it's relevant. It's a material fact. So these are things that we look at. So beyond the 4 statements, there are other things in annual reports or filed reports that are useful for us as outside analysts. The audit report, as mentioned, comes from the auditor, and a clean report means that they have found that it fairly presents. So when you look at all the verbiage in 2 pages, what we're looking for are 2 words, either presents fairly or fairly presents, right? Something like that, which means that you can use the statements. That's what fairly present means, is that if you use the numbers on the statements, you can use those numbers because they fairly present what happened. So that's one thing we always look for. The other we look for is their opinion, anything that is out of the ordinary, anything in their accounting practices that don't look right, or internal controls that don't look strong enough. So they also have to report on that. So these are things that you'll find in an auditor's report. Now, what's underneath it is certain presumption, is that although the auditors look at transactions, there's no way they could look at 1 million or 10 million transactions. Like, imagine auditing Amazon, how many transactions they have a year. So the auditors of Amazon would do sampling. They'll test some transactions to make sure the accounting processes are done correctly and in accordance with GAAP. But it's management's responsibility for financial statements. Auditors only do spot checking. The other is this sampling idea, is that we do sampling as auditors, and therefore we have some statistical validation that the numbers look right, but it's not looking at every single transaction. The other is that there's reasonable assurance that it is materially okay, right? It seems like hedge words, but it means that, let's say again with Amazon. Let's say Amazon says they have $500 million in cash. If they actually are off by $5 because somebody miscounted a cash box somewhere, is it technically accurate? No, it's not accurate. It's off by $5. But really, $5 out of $500 million, is that material? The answer is no. So the statement is technically incorrect, but it is materially correct. And that's what the auditors are saying, that their standard is that the numbers are materially correct. So you won't change your mind if the number were corrected. And then the other thing is that the policies and practices are part of the review of conformance with GAAP and with internal controls. And these are the 2 words that we looked at. Presents fairly, which is kind of the green light for us to use the statements and move forward with our analysis. So who has authority and responsibility? So this is the field of governance. Well, you'll hear the word governance a lot. It means, how do major decisions at a company take place? And so here, stockholders, they own the stock, right? They get to vote and elect the board of directors. So technically, stockholders are the bosses of the directors, because they select them, and they could fire them too if things get bad enough. But they vote to elect them in. Next is that the board of directors oversee executive managers, notably the CEO and CFO. So this is the hierarchy of how it works. So stockholders elect the board of directors, who looks at high-level things for the company, and they empower managers to run the business on a day-to-day basis. Then the audit firm, as the outside entity, will kind of look over the financials. They actually report to the board. They look over the financials, and then they tell stockholders, and if it's a public company, the general public, on how well the company did in terms of complying with the rules of accounting. So that's how it works. So these are the levels. We have stockholders electing board of directors, who in turn supervise and in some cases help hire the CEO and executive management team. An outside firm is hired by the board to be critical in their analysis of how well the company is doing from a procedural standpoint. Notice that audit firms are not evaluating the profits or evaluating whether it's a good investment. They're more fact-based. It was the accounting done right. So they often leave the judgment to you as the user of financial on it's good or bad or indifferent. That's your choice. It's your judgment. Their job is to make sure the numbers can be used by you. And that's what auditors do. Sarbanes-Oxley, I alluded to it earlier, was the result of a bunch of fraud that happened in the 2000s. Roughly 1999 through 2001 was kind of a crazy period of time, and a lot of companies were going public, a lot of gamesmanship was happening, and it led to abuse. So now Sarbanes-Oxley has been approved as in place. It's the law. And we have some changes. So some of the biggest changes are the CEO and CFO have personally reviewed and they personally sign. And if there's something going wrong with the controls in a company, they can be put to jail, they can be fined. In the past, white collar crime, as we call these things, you didn't go rob a bank. White collar crimes, where they kind of lie, was not punished as severely as people would think or people think should be. And so Sarbanes-Oxley changed that. It makes it explicit with every single statement, financial statement, that the CEO and CFO will sign. And if something's wrong and they're fraudulent or incompetent, they could go to jail. The other is that this level of materiality, no untrue statement of material facts are misleading. So that speaks to the usability and quality of the information. And here is the fairly presents, again, in case you didn't get it. This is the third time I've mentioned it. And then material facts are disclosed. So there may be a fact that is not disclosed, which now itself is a violation. Here's an example. Let's say a company has run its business and it's a multi-billion-dollar company, but it's being sued for a patent infringement. Right? But it hasn't been tried yet, but they've been sued by a major company, and it's a serious lawsuit for patent infringement. Well, is that material? In other words, if you're a shareholder, does it matter to you if, say, Apple is being sued by Samsung? That actually happened. So in that case, would you want to know that Samsung is suing Apple for, say, $500 million? Well, I think you'd want to know that. So that's an omission of a material fact, right? So if Apple did not tell you that they are being sued and it looks serious by Samsung for patent infringement, that's a violation. That's a misstatement, not by what you said, but what you did not say. So disclosure is a big deal. And then the other thing is that the internal controls are in place. So that's the third part of Sarbanes-Oxley. So these are things that we would do before SOX. I mean, these are not new to the accounting profession, but they're new because there's teeth in enforcement. And Sarbanes-Oxley just made the consequences higher for people to do what they should be doing anyway. It's a sad fact in America, probably your countries as well, that people should do things and they don't. And now laws have to be in place so that if they don't behave, they go to jail or they pay a fine. That's kind of how things work. Next is a point which may or may not be obvious yet, but it will be when we get into the nitty-gritty of accounting, that is not exact. People think that accounting is an exact and it's science. It's not. There's a lot of judgment involved. So when we have these choices in policy, it makes a difference. And we also have judgments and estimates, and those all matter. So again, for now, just take it on faith that there are judgment calls and kind of inaccuracies and ambiguities in accounting. When we go again into the real accounts and the real information, I'll show you where it's most likely to crop its ugly head. And it's well known. It's not a secret. It's just the nature of accounting. So we'll show you the areas of precision, like cash. Cash is pretty precise. And we'll show you areas of imprecision. And that would be things like reserves or allowances. These are imprecision, but they're all part of GAAP.